Ejiro, yeah. Good afternoon, distinguished ladies and gentlemen. My name is Nkemdelin Ihanacha. In addition to being a faculty member in Lagos Business School, Pan Atlantic University, I also lead the supply side team in the Sustainable and Inclusive Digital Financial Services Initiative in Lagos Business School, Pan Atlantic University, an initiative that was established 5 years ago with the sole aim of driving research, stakeholder engagement, and capacity building in the financial inclusion ecosystem, all with an aim to helping support FSPs, support regulators, as well as support in facilitating a properly functioning ecosystem in Nigeria. It gives us great pleasure to welcome you all in partnership with DIVARA to this first public webinar on supporting the payment service bank regime in Nigeria. We are indeed delighted this afternoon, and we thank you all very much for accepting to join this very exciting and very important discussion that would help us in better understanding how to properly position PSBs in the financial service ecosystem in Nigeria, as well as learning from other clients as to what has worked, what hasn't worked, and how specifically we as operators, regulators, as well as other players in the ecosystem should better position ourselves to achieve high levels of financial inclusion, better effectiveness of our payment service banks, and overall, a very well-functioning financial services ecosystem. We are privileged this afternoon to have in our midst some very distinguished guests. One of our panelists, permit me to introduce, is Professor Olayinka David West, who is currently the Associate Dean, Lagos Business School, Pan Atlantic University, as well as the Director of the Sustainable and Inclusive Financial Services Initiative in Lagos Business School. Thank you very much for joining us, Professor David West. We also have in our midst another very distinguished regulator and banker of several years of experience, Mr. Musa Jimoh, who is currently the director of the Payment System Management Department at the Central Bank of Nigeria. Mr. Jimoh, we're indeed privileged and we're honored to have you this afternoon. Thank you very much for joining us. And then also several of my colleagues who have worked tirelessly day and night to put this program and project together. I want to give special thanks to Mr. Timothy Aluko, the Program Manager of Sustainable and Inclusive Digital Financial Services Initiative in LBS, as well as all my several other colleagues, Emmanuel, Tenitayo, Samuel, Ibuku, who have worked day and night to put this very exciting program together. Now, permit me very quickly to now introduce the panelists who are going to be speaking to us over the next 2 hours. I'll start by introducing Mr. Dikpo Fatogu. Dikpo is a fellow of both the Institute of Chartered Accountants of Nigeria as well as the Chartered Institute of Bankers in Nigeria. Dikpo has extensive financial services experience both in the public and private sectors. He has a Bachelor of Science degree in accounting from the University of Ilorin, as well as a Master of Business Administration degree from the University of Lagos. He's attended several programs locally and internationally on policy, payment systems, oversight in several countries of the world, most notably the United States, India, to mention but a few. Dikpo served as the Director of Banking and Payment Systems Department of the Central Bank of Nigeria, and he was also a Deputy Director in the Banking Supervision Department of the bank. In his capacity as a regulator, he has under his belt more than 35 years of experience driving policy and then also shaping the sector as we currently have it. Dikpo is currently the managing partner of Jaspolin Consulting, which is a payment system consulting and strategy firm. He also sits on the board of United Capital PLC as an independent non-executive director. Also, permit me to introduce Dipti George of DIVARA Research. Dipti is the Deputy ED and Head of Strategy in Devara Research. Devara is an Indian policy, research, and advocacy institution. Deepti leads the thinking and advocacy on issues in financial systems regulation, banking, consumer protection, institutional conduct, financial inclusion, retail, and wholesale financial services within Indian and international jurisdictions. She has under her belt more than a decade of expertise in institutional design aspects of financial inclusion, and was also called to the technical secretariat to the Indian Central Bank's MOC committee that recommended for the Indian market, wholesale banks, payment banks, and the right to suitability for the retail customer. She's also had opportunities to contribute formally to other committees of the central bank and undertake research for pensions, as well as government credit products for the informal sector. Thank you very much for joining us, Deepti. Deepti has a postgraduate diploma in management from IFMR, specializing in finance, and she's a mother to a cute 4-year-old boy. Thank you for joining us, Deepti. And then very quickly, I'll be introducing Madhu Srinivas. Madhu is an experienced public policy professional with close to a decade of experience in the financial sector, of which 5 years is in financial sector policy. Is currently a senior research associate in Devara Research under the Financial Systems Design Initiative. His main areas of expertise are banking regulation, consumer protection, financial inclusion, and as part of the work he has done in banking system design, he has written and extensively researched on policy and has written policy briefs and articles on stress testing methodologies, credit guarantee schemes, and competition in the Indian banking sector. He has also co-authored a research on reimagining the banking business model, in which a bank only aggregates credit risk and highlights regulatory, institutional, as well as infrastructural changes required to enable the development of such banks. He's also done some work on consumer protection. In the course of his research, he's authored empirical papers that have analyzed the impact of information disclosure on consumer behavior. He's also done a lot of work on lending, financial dailies, and has collaborated with institutions like Bloomberg, Queens, Money Control, etc. He's completed his PGDM from the Institute of Financial Management and Research, and is also a certified financial risk management professional by GARP. And then also I have the pleasure of introducing Amulya Neelam. Amulya is a research associate working also with the Financial Systems Design Initiative at Devara Research. In the 3 years of her work in Devara, she's worked on questions of suitability of retail financial products and its implications for financial service providers, the role of different banking design models in enabling financial inclusion, and on enabling the framework for regulation supervision in India to better enable borrower outcomes and financial stability. She's worked on assessing whether the new licensing models of small finance banks and payment banks instituted to enable financial inclusion in India have progressed on their goals. On the supervisory side, she's worked with support from CGAP and also co-authored a report on how the Indian Central Bank's credit monitoring and supervision system could be improved to build local capacity. She's had prior experience in working in livelihoods and the education assessment, and holds a postgraduate diploma from the Institute of Rural Management, Anand. Ladies and gentlemen, this afternoon, we're going to have a very rich conversation. So to give you a sense of the members of the audience, we have today several deposit money bank executives. We have microfinance banks, we have pension operators, we have regulators, we have switch operators, we have fintechs, we have research institutions, and then we have represented here all the PSBs, we have super agents. In all, we're going to have a very robust class, a very robust group. At the last count, we have over 120 attendees and still counting. We're going to have a lot more people signing. And then we also have representations from Nigeria. We have attendees dialing in from Ghana, from the United States, from France, and from Kenya. So we indeed have also a global audience. What are we going to be talking about very quickly today? So right after my introduction now, we're going to have a stage setting where we're going to set the stage for payment service banks. Right after the flag off and the intro by Deepti, we would have that section introduce the thinking and the evolution of the PSBs in India from financial system design, practice, highlighting horizontally and vertically differentiated banking systems, focusing on 3 critical elements. After that, we'll now have a second presentation that speaks to the PSB journey so far. So what has happened? How many applicants applied for licenses to operate PSBs? How many were given approval in principle? Who are operational? And what has been their impact from whatever we can glean from publicly available sources of information, as well as the very rich and remarkable work Devara has done in this space. And then we're now going to have a wrap-up presentation by our own very Mr. Fatoku, who will tell us specifically what the journey so far has been, how PSBs were conceptualized in Nigeria, and specifically how this system and context has evolved. Now, ladies and gentlemen, in the course of all of these presentations, I strongly encourage you to avail yourself of the chat window as well as the Q&A window. So as the presentations go on, feel free to post in your questions there. And as much as possible, the panelists would respond to those questions and give you feedback. And then for those of them that we're not able to take, we will now take them at the end of the feedback. Thank you very much, ladies and gentlemen. I'll hand over right now to Deepti to flag up.
Wonderful, thank you. Can you hear me?
Yes,
we are hearing you. Go ahead, Deepti.
All right, wonderful. Thank you, everybody, and thank you, Lagos Business School, Dr. David Best, and everybody else who have been involved in organizing this webinar. You know, we are very grateful for this opportunity to be able to share what we know about the payments bank model, how it got conceptualized, and where and the journey so far in the direction that it has taken, and to just share our findings of work that we've done on this subject. So we've divided the session into 2 halves. One is really just stage setting and talking about what was the need for this kind of a construct in India. Where were we in 2012, which led to the creation of, or even led to the recommendation by the Moore Committee report. So, and the second, and then it goes on to talk about how the RBI perhaps conceptualized its own version of the payments bank model, and then licensed a set of entities who had applied for the model. And then since then, the second segment will then be, segue into understanding how have the licensed entities performed against financial inclusion goals or against payments inclusion goals, to be very specific and objective in our analysis. So I must say upfront that we have used only publicly available data. And to that extent, our work will be limited to that extent. But I think we unfortunately do not have any numbers on profitability because these entities are not yet listed, and entity level data isn't available. So before we jump into that, I'm sure some of you might be wondering who we are. So I'll just spend 30 seconds just talking about who we are. Dwara Research is a financial sector policy research and advocacy organization focused on ensuring complete access to really high quality and suitable financial services, particularly for those excluded. So we are talking of underserved, the low-income households, small enterprises, and even local governments. And our work is very much, we are a non-profit organization. Our work is very much both proactive as well as reactively analyzing and even, putting out positions or position papers, and also responding to, say, draft policy notes or even regulations put out by the various financial sector regulators, and clarifying to them using data and evidence to say why we think these kinds of changes are required in order to accelerate access to good quality financial services. So I think I'll stop there. Please feel free to ask questions over chat or as planned by the moderator. So I will, I hope that's fine. I'll kind of hand over to my colleague Madhu to move into segment 1. Thank you.
Thank you very much, Deepti.
Thanks, Deepti. Yeah. So can I share my screen now?
Yeah, please do.
Yeah. Yes, everybody able to see my screen?
Yes,
yes,
we can see it clearly.
We can see it clearly.
Okay, yeah, I'll jump right into the presentation. So, like Deepti mentioned, first, before we go into the the payments bank model, we need to see what is the rationale for this payments bank, what was the need for the payments bank. So, to that extent, let me describe the payments landscape in India in 2012. So, if you see the providers, there were only 2 sets of providers providing payments and remittance services in India. One were the full service banks. The other were entities, non-bank entities called prepaid instrument providers. So this was similar to the mobile money operators operating in Nigeria. So you could do, there's no cash in and cash out services being enabled by them, but then you can transfer money, pay for goods and services using digital wallets. And also there was a heavy reliance on physical infra for payments and remittance services. So that's characterized by ATMs, point of sale devices, bank branches. And also we had this business correspondence. So this is again similar, analogous to the agent banking model that you have in Nigeria. So where you use corporate and also individual entities to go into remote parts of the country and do basic payments and remittance services. With regard to the payment mode, it was predominantly based on cash. There was, even though there were presence of cards, and also the predominant payments mode was also through checks. We had internet-enabled banking, but then, as you can see, the average volume of card payments in India was very low, only 1,200 rupees per capita. The regulator for all this was the Reserve Bank of India, the Payments and Settlement System. And the main market infrastructure provider in India at that point of time was the National Payments Corporation of India. So this is an umbrella entity which oversaw the retail payments and settlement systems in India. So, and all this combined, what was the outcome? The outcome was, at that point of time, only 36% of the adult population had a bank account in India, right? So that's like really, really low. And there were some strategic and operational barriers which which led to such an outcome. Right? So, since independent banks have played an important role in furthering financial inclusion in India, the flip side to that was there's a legacy of relying on branch-based banking for furthering financial inclusion in India. Consequently, what happened was that at an operational level, your main payment access points were consisted of ATMs and bank branches and BCs, which were high cost models and not easily scalable in some sense, right? And therefore you had a lot of, you had a very sparse branch per capita number in India. So you had only 11.14 bank branches per 100,000 adults, or in this case, banking touch points. Another problem was that there was reluctance on the part of the regulator to sort of co-opt non-bank financial institutions due to a perceived lack of credibility among them. And this meant that the reliance was solely on banks to further financial inclusion, and you could not really leverage on the extensive customer touch points that mobile phone companies or your retail stores had, or even the post office system, right? Another problem because of this was that most of the access points, the banking access points, were skewed towards urban areas. So at that point of time, close to 90% of all urban areas had 25 or more payment access points per 10,000 population, but only 3% was the corresponding figure in the rural areas. So there was heavy skewed towards the urban areas, which were already in some sense quite well served. But then the need was we need to expand payments and other aspects of financial inclusion in the rural areas. Another sort of related strategic problem was the reluctance to encourage the use of electronic money in India, right? So there was a sense of fear on the regulator that this would lead to a loss of seigniorage income and also a sort of loss of control of the monetary policy in some sense. So all this combined would, at that point of time, led to a low penetration of financial services and especially payments and remittance services in India. So in this context came the Moore Committee report. So in our 2013, RBI tasked the Moore Committee report with laying down a set of design principles for furthering financial inclusion and deepening in India. So the ambit of the Moore Committee report was not confined to only payments, but also included all other aspects, including insurance, credit, consumer protection, so on and so forth. But for our presentation, we'll be concentrating on what Moore Committee report sort of recommended with regard to payments, especially the payments bank. So the idea of payments bank came from the vertically differentiated banking design system that the Moore Committee report advocated. So what is this vertically differentiated banking design system? So simply put, so the Moore Committee viewed banks as performing three distinct financial functions: payments, deposits, and credit. And typically what we see is that all three functions are usually performed in the same entity. So this is what the committee characterized as a horizontally differentiated banking system. So in this, you had one entity performing all three functions, and the various sort of entities were differentiated according to their sector or geography. So for example, you have the small finance bank or the regional banks in India, which perform all three functions of payments, deposit, and credit, but then they are confined to one particular region, a few districts or a few states, for instance, right? Now, the Moore Committee thought that this was not an ideal sort of design system which could accelerate financial inclusion. So it proposed a different sort of design system called the vertically differentiated banking system, in which entities would be free to do one or more of the functions of payments and deposits and credit. So over here, the differentiation is based not so much on the sector or the geography that the entity can operate in, but what is the function that the entity can do. So it is from here that we got the idea of payments bank, which would do only payments and deposit services and no credit services. Now, one big sort of advantage over this is that this would greatly expand the universe of entities eligible for applying for payments bank license without a concern of self-dealing, right? So one of the main sort of limitations in giving out licenses to banks in the HDBS sort of design system is that there's always a concern that license is given to real sector entities, let's say industrial houses. Using the bank license, they would get access to public deposits, and these public deposits can be used to sort of on-lend to their group companies without adequate due diligence. And that would greatly increase the systemic risk and risk to the retail depositors. But with regard to the payments bank, since they don't do any credit and they are mandated to only invest in government securities, there's no risk of self-dealing. So that was one of the big advantages of the separation of financial functions. So to that extent, the payments bank model directly addressed some of the barriers that I spoke to earlier, right? So the payments bank model allowed the participation of real sector players without the risk of increasing the system, the vulnerability of the system or the concerns of self-dealing. So because of this, the telcos, the supermarket chains, or the post office system, which already have a lot of customer touch points in magnitudes greater than what the banking system can achieve. So these touch points can be leveraged to expand payment access. A related sort of point of having, co-opting technology-driven companies like telcos is that this is a low-cost provision of services. So the banking outlet definition now changes from an ATM or bank branch to just your mobile phone, or even a simple BC, right? Or even the local the local departmental store, what we call as kirana stores, right? So this low-cost service model is can be expanded or scaled up much easier and faster than the brick and mortar based heavy cost bank branch model, right? And this would also sort of bridge the last mile connectivity gap that existed in India at that point of time. So another sort of important recommendation of, or rather the aspect of the payment bank model is, in addition to charging for the transaction and payment and remittances, payments bank can also act as agents to other banks and also do third-party sales of other financial products like mutual funds or insurance without any risk participation, of course. So this adds revenue adjacencies to their model and sort of helps their profitability in some sense. So over here, I'll be comparing the payments bank model with the PPA issuer, or the what you could call the mobile money operator, and the full service bank with the BC sort with the BC network, right? So function wise, if you see, they're all quite similar. So both payments bank and the PPA issuer can provide payments and deposit services with a cap. They cannot, well, payments bank can provide interest on deposits. PPA issuers cannot provide interests. And again, the advantage with payments bank is there's no restriction on cash in and cash out, whereas PPA issuers, there's no cash out or very limited cash out services available. Again, full service bank, they can provide the entire gamut of services. In addition to what payments bank can provide, they can also provide credit. So with regard to the KYC requirements, at that point of time, the PPA issuers had relaxed KYC requirements. And this was a concern because that exposed them to anti-money laundering risks. Whereas this was not present in the payments bank conception or the full service bank with the BC model. Payments bank and PPA issuers had a maximum limit on the amount of balances that they can keep, whereas the full service bank did not. For payments bank, any balance above this amount would get automatically swept into another account of the full service payment bank, a full service bank. Right? Again, in deployment of funds, payments bank, they were severely sort of restricted. All balance proceeds were to be deposited in government securities with duration of less than 3 months. PPA issuers, they were actually had only an escrow account made with the full service bank. So there was no concept of deployment of funds per se. However, because these PPA issuers had in some sense a nested sort of account, so they had an escrow account within a full service bank, there was a contagion risk, wherein if the failure of the full service bank would affect the customers of the PPA, because unlike the other depositors of the full service bank who would be protected by deposit insurance, the customers of the PPA did not have any such insurance. They did not have a deposit insurance. So if the sponsor bank went down, the customers of the PPA issuers will also get heavily affected. So this was a contagion risk that was present in the PPA issuer, but not so in the payments bank model. Again, with regard to access to payment and clearing systems, payments bank had full access. Payments bank and the full service bank in the BC model had full access to the payment and clearing settlement system, whereas the PPA issuer operated through the existing payment bank model. So on the face of it, it seems like the payments bank and the full service bank with BCs had sort of very similar functions and sort of reach. But the main difference over here is that in practice, the BC model was not financially viable at that point of time, especially in the rural areas. So scaling up that BC model would probably help only in the urban areas, but then to expand financial inclusion in the rural and more sparsely populated areas, that model was not deemed viable, which is also one reason why the Moore Committee report went specifically with the payments bank model and not a PPA issuer model or a full service bank with a BC model. Now, in all this, I want to make a point in that the Moore committee report did not reject the existing banking system of the horizontally differentiated banking system, but it just said that the model that's proposed by it would act as a complement to the existing banking system that would further accelerate financial inclusion, and in this case, for payments and remittances. So now I will try to compare what was the Moore committee construct of the payments bank model and what actually RBI put out as guidelines for the payments bank later on, right? So for most part, the RBI guidelines remain faithful to the Moore committee construct. There are some variations in threshold, but that is due to the time lag that happened. But the main difference in this between these two sort of constructs, payment bank construct, actually comes in the one is the scope of activities. So the Moore committee construct specifically mentioned acceptance of demand deposits, payments, and remittance services, whereas the RBI guidelines expanded that further to include that the payments bank could also act as a BC to a bank and distribute third-party financial products, and also undertake forex transaction as part of the remittance businesses. Another important distinction between these two constructs is that the Moore committee specifically mentioned that PPA issuers, because of the risks outlined above, were required to apply for either payments bank license or convert themselves to a BC, and no additional PPA licenses were to be granted. However, the competitive landscape has remained much the same. In fact, now PPAs are also required to do full KYC, and they have also been allowed interoperability amongst themselves. While the full KYC addresses the AML concerns that I talked about earlier, the contagion risk, wherein the PPAs deposits are nested in a sponsor bank, so that still remains. And to that extent, the payments bank model is more secure and poses less systemic risk, and also both to the financial system and to the depositors than a PPA model. Okay, now in the next couple of slides, I'll try to, So in the next couple of slides, I try to briefly outline what is the Nigerian context and try to compare the, the payment service bank model of Nigeria with the payment bank model as articulated by RBI. In doing this, I just want to caveat saying that I am no expert on the financials and the financial system of Nigeria, and I'm sure Mr. Deepo Fatokun would be expanding on this in a much greater detail. So I'll be just doing a brief comparison over here. So if you see the Nigerian context, your proportion of the banked adult population is close to 40%, similar to what we saw in India in 2012. And among formal non-bank entities, so you had the mobile money operators who had 3.3% of the population transact through them. And over there also, you have affordability and institutional exclusion, which appear to be the main barriers in opening a bank account. And most importantly over here, so similar to what we call the Aadhaar number in India, which is a unique identification number, a project is also underway in Nigeria to provide all citizens and legal residents with a national identification number. And this would help, this is considered sort of to help further financial inclusion by easing your account opening and I think transaction services. So when we compare the RBI construct with the construct of the Central Bank of Nigeria, again, we see a lot of similarities. It's very similar in terms of the objective, in terms of specific regulatory prescriptions, in terms of deployment of funds, lending activities, so on and so forth. Again, even in terms of the ownership of who are the eligible entities who can apply for this construct, it's quite similar, the range of entities, the type of entities that are covered. The main difference over here arises in terms of the permitted activities. So in the case of RBI, like I had mentioned, the payments bank can act as an agent to another bank. and also distribute third-party financial products on a non-risk sharing basis. So that acts as additional revenue streams for the payment bank. In the case of the Central Bank of Nigeria, the Payment Service Bank. So from what our understanding is that in addition to the payments and remittance services, they can also provide investment advisory services to the customers. So that is also one additional sort of revenue stream. But yeah, so this is our sort of understanding over here. And I think I'll just stop over here and let my colleague Amulya walk you through to the actual payments bank journey that has happened in India.
Thank you very much, Madhu. Very insightful presentation.
So fast.
I think we'll just do the handover to Amulya so that she can kick in.
Okay.
Thank you very much, ladies and gentlemen. Please keep your questions coming into the Q&A window specifically and not the chat window. Thank you, Amulya. Please, over to you.
Okay. Thank you. Good afternoon, everybody. I'll just get started with the presentation. I hope that's visible and I hope I'm audible. So what we've seen so far in segment 1 is how the idea of payments bank, the model came about to be. So here I'll be talking about how each of the payments banks in India have been functioning. So what we have here is the agenda for this segment. So first I'll show what has been the timeline of the different events with respect to the payments banks. And then I'll take you through a snapshot of the kind of entities that apply to be payments banks, and also what is the nature of those which have received the licenses. And then I'll talk some details about what have been the features of the models of the 4 fully operational payments banks in India. And then I'll tell you about how we've approached our analysis in this work that we've done, and take you through the results in terms of touch points and transactions. And then I'll talk about what has been the competitive landscape of payments banks in India and how it has changed over time. And then I'll also talk about the challenges the payments banks have faced since they began operations, and then just conclude the entire segment. Okay, so what we have here is the timeline. We see that in November 2014 is when RBI released the guidelines for the licensing of payments banks. And in the next year, in 2015 of Feb, out of the 41 applicants, RBI granted in principle approval to 11 of these entities. In the following slide, we'll look at details of what kind of entities these 11 and 41 were. But just in the next year, in the period between March to May, 3 of these entities surrendered their licenses without even beginning operations. Again, I'll look at some more detail in the coming slide. So one of the key events that happened in 2016 in April was that UPI had launched. UPI stands for Unified Payments Interface. It's this mobile platform through which you can do real-time interbank transactions. So this platform essentially worked as kind of like provided a push towards an increase in digital payments in the country. So we now see that UPI has seen an increasing share of not just the digital payments, but also the total payments in the country. And another event that happened in 2016 in November of that year is the demonetization. So there was a demonetization of two banknotes of ₹500 and ₹1,000. So these were demonetized overnight and were supposed to be replaced with new 500 and 1,000 rupees notes. I mean, there were many objectives assigned to this particular event, but a definite consequence of this was that it saw again a push in an increase in digital payments in the country, and also a sort of popularization of certain payments modes such as prepaid instruments, which are like wallets. And in the same year, again, it was Airtel Payments Bank, which was the first payments bank in the country, which began operations. And in 2017, over a period between Jan and June, so we had 3 other payments banks, India Post, Paytm, and Fino, which began operations. And these are all 4 of these are now fully operational. And in 2018, we had 3 payments banks which began operations. This Aditya Birla is currently not operational. whereas the other two are still in pilot phase. And so the last two events that you see in the timeline in October 2018, so this is with respect to the prepaid instruments, the e-wallets that Madhu spoke about. So there were interoperability guidelines which were issued by the central bank in October of that year, 2018. What it essentially did was enabled transactions across wallets and to bank accounts using UPI. And another event that happened with respect to PPIs and is that in 2020, there was a limited cash out solution which was enabled via UPI. So the last two events pertain to how the competitive landscape for payments banks kind of changed, and I'll go into greater detail later on. So this is it about the timeline. So now I'll be talking about what were the nature of applicants and the licensed entities. So among the 41 entities who applied to be payments banks, close to half of them were prepaid instrument providers. So these were wallets and other similar payment solutions. And otherwise, other applicants included two large mobile network operators, or MNOs as we call them. And both of them were given licenses. So other than these, there was also an agent services provider, which was also given a license. And we also saw among the applicants, a number of financial services providers, technology services providers also. And notably, we also saw a credit cooperative society, a satellite service provider, and a promoter of a large retail conglomerate. So that's just about the kind of entities that had applied to be payments banks. So now looking at the entities which received licenses. So what we see here, the first four are the ones which are fully operational right now. So the first one is Airtel. So Airtel, like you all know, it's a subsidiary of Bharti Airtel, which is a large mobile network operator in the country. And the next one is Department of Post. This again is a large network in terms, because it's the government operated postal system. And the third is a person called Vijay Shekhar Sharma. He is the individual promoter of a mobile internet firm called Paytm. It's one of its main services is that it provides a wallet, which again, this particular Paytm wallet grew, saw significant usage, especially after demonetization, and sat the top of mind of the general public in recent years. And the last one among the fully operational ones is Fino Paytech. So again, the nature of this entity was that it mainly provided agent services and also banking technology services. So the next two are the ones which are in pilot phase. So the first one, as it says, it's NSDL. It's a securities depository provider. It's called National Securities Depository Limited. And the other one, which is in pilot phase, is Reliance Industry Limited. This also is it's a large multinational conglomerate. One of its subsidiaries is a mobile network operator called Jio, and that's the name of the payments bank, the Jio Payments Bank. So that's it for the operational ones. So these are the ones which have surrendered their licenses. So the remaining 5 of them. So this is Aditya Birla Nuvo. This is also a subsidiary of a large multinational conglomerate, and this particular subsidiary worked in financial services, pretty broad-based in nature. And this was the only entity which surrendered its license after beginning operations. So it operated for a while, for about 17 months. It had set up a payments bank in a joint venture with another mobile network operator, Idea Cellular, but then it shut operations, citing competitive concerns and how it didn't see its business model working out. And Vodafone M-Pesa was also one of the entities which received a license. So as you all know, Vodafone is again a mobile network operator, and this particular subsidiary worked in providing mobile phone-based money transfer as well as providing agent services. The reason for this surrender is just that this Vodafone got into a merger with Idea Cellular, and because Idea Cellular also, along with Aditya Birla, we saw that they had a joint venture of a payments bank. Because we couldn't have two payments bank under the same umbrella. That is why this particular one surrendered his license. So the next three actually surrendered their licenses even before they began operations. Cholamandalam is the nature of the entity which had applied for it and received the license is a financial services provider. One of its main offerings was wealth management. And Dilip Sanghvi is an individual promoter of a large pharmaceutical company. And Tech Mahindra is again a multinational technology company, mainly known for being a technology company, but it also works in financial services with respect to leasing and lending. So these two entities again cited competition concerns and how they were afraid that because of the competition, their already thin margins would be eroded. So that was just a snapshot of what were the entities that are operating and had licenses and so on. So now just taking a closer look at the ones which are fully operational, right? The first four that we saw earlier. So the first that we see here is Airtel Payments Bank. As we've seen earlier, this is the one which started functioning first, and it has the largest network of touch points of around 500,000. And this is largely due to the parent's retail network of the parent's retail parent is a MNO, right? So it has a retail network of more than 1 million touch points. And it also has this added advantage that its agents are already familiar with doing cash management as well as taking customer details in some form of KYC, right? So Airtel also kind of takes advantage of this knowledge by providing cash management services to other entities. So the next that we'll look at here is the India Post Payments Banks. So this is also an interesting model because its parent is the postal network in the country, and they have a very good geographic spread of branches because India Post Payments Bank has this. What it did was set up one branch in every district of the country. So there is a branch within the premises of the postal office. So because of that, not only does it have a large number of branches, both in terms of absolute numbers as well as proportion of its touch points in comparison to the other payments banks. The branches are also widespread because if there is one for every district, so it's covered even the lesser, usually lesser covered regions like the Northeast and Central, etc. And in addition to these branches, it has also enabled around 88% of its existing network of post offices. So even if there is no fully functional branch, at least you can do some form of payment banking services in about 88% of the post offices in the country. In addition to this, a certain proportion of postal workers were also trained and equipped to be able to provide payments banking services, and they also did doorstep banking services. So the 331,000 touch points that you see comprises of both of these post offices, which can provide the services, the branches, and the postal workers who are kind of like on foot and can provide payments banking services. So the next model that we look at is Paytm Payments Bank. So this is again like quite a different model compared to the others because it's largely functions on a digital model. And as I mentioned before, it's as in its earlier form as a wallet, it's a huge success, which was able to carry forward after converting to a payments bank as well, right? So it also has this a kind of a smaller network of branded retail outlets. It picks up retail outlets and calls them Paytm ka ATM, and at which you can do banking services to some extent. And there are additional some designated KYC points, which even if you cannot do banking services, you can have those agents who come and do KYC for you. So this is how they've kind of set up their physical network. And like I mentioned earlier, their parent is 197 Communications, which is visually like a mobile marketplace, and it receives also a good funding from foreign sources, including it has a 25%. It receives funding from the Alibaba, one of the Alibaba affiliates, which has around 25% stake in Paytm's parent. As you can see, the number of touch points are slightly lower than the others, and this is again can be attributed to their largely digital model. And the last one here among the fully operational ones is the Fino Payments Bank. And here again, this it brings in significant experience in terms of the agent banking model because of the parents functioning as a business correspondent or an agent services provider. And Fino also kind of does these interesting partnerships with different agents. For example, it has a partnership with Bharat Petroleum, where they set up banking points in petrol pumps in throughout the country. And they also have partnerships with a couple of state governments where they provide services as their corporate business correspondent or corporate agent. Right. So even if you look at the product suite, they have like both savings and current accounts, and almost all of them also have a sweep account facility. So if you in addition to providing demand deposits, if you go above the 100,000 rupees limit, that amount can be swept off into it's a bank's account where it sits as a term deposit. Right. And in a couple of cases, you also see that the payments banks are providing the third party service such as insurance. And we also see that at least as per news reports, we know that one of the banks, the Fino Payments Bank, is also providing BC lending. That is, it's acting as an agent to another bank, a full service bank, and being able to provide credit to its customers. Doorstep banking is again one of the kind of a product advantage that payments banks can provide, which is currently being provided by India Post and Fino. So this is about the 4 fully operational banks in the country. And we see that there is considerable diversity and scope for differentiation and advantage for each of the different types of payments banks. Now I'll talk about how we've approached our analysis in terms of understanding how well these payments banks have progressed on their financial inclusion goals. So as mentioned earlier, we studied the 4 fully operational ones, left out the 2 pilot ones because they're functioning on a very limited scale in terms of geography or customer segment. So one thing that we've kept in mind throughout the analysis is what is the value of a payments bank, right? That they can provide cash in, cash out, CECO services using their wide retail network, and how this is really quite a differentiator from the prepaid instruments, which you can use them to do transactions, but not CECO to a large extent. So in our analysis, we've focused on these questions to see how they've done on financial inclusion goals. We've looked at whether there has been a proliferation of transaction touchpoints and whether there is a difference in the nature of transactions enabled by payments banks versus full service banks. And again, with respect to our data sources, like Deepti mentioned, all of these are public in nature. So we have the central bank's database, and we have the Ministry of Corporate Affairs database where we refer to them for some financial statements. And apart from these official sources, we just refer to their company websites, annual reports, news reports, etc. So coming to the results of this analysis, first looking at the number and nature of touch points. How we've defined touch points is just to look at all of the physical access points, which can be used to enable payments bank services. So these can include business correspondent points, even though they're not fixed, that they can provide as a physical access point, and point of sale terminals, POS terminals, ATMs, as well as branches, obviously. So we've seen that all of these 4 fully operational payments banks contributed to a huge network of over 1.3 million touch points. And this was actually even the idea with which the central bank set up or put forward the idea of payments banks, that they were expected to differentiate by setting up and utilizing a large network of touch points. And another peculiar feature of payments banks is that their touch points is largely non-branch in nature as compared to full service banks. For example, if you see Paytm's 100,000 points here, among the 100,000 touch points, only 7 of them are branches, right? And so this is quite in contrast to full service banks, which have a very low ratio of, say, agents to bank branches. Sometimes they even have more branches than agents, but that's not the case in payments banks, where it largely functions on a agent-based banking. And looking at the branch spread, like I mentioned earlier, India Post Payments Banks has large number of branches and comprising of 85% of total. And this is again because of their policy of having one branch per district in the post office premises. So because of that, we also see that there's a good regional coverage, right? So even in Northeast, which is like a smaller, not very well-serviced area, you see that there are quite some number of points. Even in terms of population group-wise distribution, so again, we must note that these are branches numbers. It would have been ideal if we had the details of geographic location of all touch points, even agents, but we don't have that, so we're just limited to the branches. But even among this, we see, even among the single digit numbers, we see that Paytm is perhaps more urban focused. But this is quite different to India Post, which is mostly semi-urban and urban in its distribution. But even in terms of absolute numbers, you see that it has a higher kind of numbers in presence in the rural areas, right? So that was that for branches. But looking at some more of the physical touch points, we have ATMs and POS, right? So we can also look at how payments banks have established to what extent have they used ATMs or acquired POSs of their own in order to extend reach of service delivery. And again, it's quite a differentiated strategy that we've seen. For example, only Fino and Paytm have some amount of ATM and POS. And Fino not as much, but Paytm, as you can see, there's 156,000 POS terminals, and this is a significant number. So their strategy has been to provide retailers with POS terminals and so that enabling of transactions. And IPPB actually, interestingly, does not issue, their strategy is not to issue debit cards, but instead to have these quick response QR cards, which are biometrically enabled, so that transactions at retail points can be again done with QR codes of the merchant. And then for any intra transactions, the postal workers could enable it again using biometrically enabled. So in addition to ATMs and POS terminals, most of the payments banks also have micro ATMs, which are again, they're biometrically authenticated. And as long as the underlying bank account is Aadhaar enabled, the transactions can be taken care of. Airtel actually has additionally has another system called instant money transfer. In certain ATMs which have the IMT enabled, you can go and withdraw cash without the need of a debit card. You just need to have a mobile number and OTP. Again, as you can see in Paytm, we also know that there's like quite a large digital presence, and many of these high numbers of debit cards are also virtual in nature, right? So that was about the number and nature of the physical, of the touch points. And if you look at in terms of progress towards financial inclusion goals, we want to analyze how many of these touch points service the unbanked areas. So RBI has a branch authorization policy, which says that 25% of banking outlets are to be set up in unbanked rural centers. And rural centers are those centers which have a population of less than 10,000 in number, and unbanked is just those which do not have access to a banking outlet. And interestingly, these guidelines were changed from branch to banking outlet. And this has happened with the advent of these new type of banks, such as small finance banks and payments banks, because it was envisaged that these new type of banks would have a different method of outreach or service delivery, which is not as branch based. And so to really cover their models, as well as to increase kind of the inclusion to beyond just branches, right? So it was changed to banking outlet. So the figure here shows the universe of touch points. So what we have here is all of the access points, but these are not considered banking outlets. Banking outlets are based on, are classified based on the kind of services that they can provide. and kind of like the timing of how long they function. So this new branching authorization allows for part-time outlets to be also counted based on their hours of operation. And so even the part-time ones get figured into this calculation of the 25%. So in 2015, there was a report which estimated the number of centers which do not have a brick and mortar branch to be around 550,000 in number, and almost all of them were in rural areas. And so if you think of this as the extent of inclusion that payments banks can do, so assuming that they adhere to their 25% requirement, we see that estimating based on the total touch points, we can see that an additional 300,000 is enabled just by the payments banks, right? So just to give you an idea, so this green graph here is the number of BC outlets or agent outlets in villages. And this is the number increasing over time. And this amount is just, and payments banks in their just 2-3 years of operations have enabled almost half of the outlets in rural areas with their touchpoint network. So this is essentially to show the kind of impact that they can do in terms of inclusion or reducing exclusion using their agent or large networks. So that was that about networks. Now looking at transactions. So one of the key objectives of payments banks is that they can also provide payments and remittance services. And so these can be at both physical and digital touch points. So considering physical touch points is ATMs and POS. So these are individual numbers. We've established earlier that Paytm has been really performing high in terms of transactions. But if you look at the average value, so this is in comparison with ICICI and SBI are two full service banks. So we see that payments banks have lower average value in comparison to the full service banks. So this kind of goes to show, probably to some extent, to show the kind of model or the kind of audience that they're selecting, where you enable high volume, low value transactions. And this is sort of true of digital transactions as well. Payments banks were seen servicing large volumes of transactions, kind of almost in competition with the full service banks as well, especially when it came to mobile transactions. And we also saw that despite the limits on their balance of 100,000 rupees, they still enabled high volumes of RTGS, which is beneficial for small businesses as well. So into what we've seen in physical transactions, even here among digital transactions, even though they did service large volumes comparable to the top 20 banks, the average value of the transaction still remained low. So far we looked at what have been the kind of performance in terms of touch points and what has been the performance in terms of transactions. But now we look at what has been the competitive landscape in which payments banks have been operating, right? So the idea of payments banks is that they act as an easily accessible store of funds through which transactions can be facilitated, and also act as small savings accounts for the underserved. But however, we saw that the interest rates on payments banks deposits, which were offered by payments banks, on an average were lower than that of small finance banks as well as full service banks. But this is because the payments banks, the model itself is not very favorable to providing high interest, even though they are mobilizing deposit for the first time, because they're constrained by the fact that they have to invest 75% of their deposits in government securities and T-bills, which are low risk, but also don't provide high returns. So they're limited in that way. But then if you look at what we've done here is to see how these limited deposits provided by payments banks have been used by customers. So what we have here is a measure of velocity of deposits, where in the financial year of 2018 to 19, we've seen what have been the balances across different bank groups, like payments banks, small finance banks, and the remaining, all of the full service banks, right? And if I take So because we do not really have data on the full transactions, the details, so these three items, ATM, value of ATM transactions, POS transactions, and mobile transactions were considered to be the universe of transactions. So what we did in our velocity of deposits measured was to look at the ratio of the total value of transactions by the deposit amounts to see what is the velocity of deposits enabled by each of the bank groups. And we can see that the payments banks is significantly higher, right? So this ratio of 221 is significantly higher than that of the full service banks is 1.32. So this just goes to show that despite not being able to provide like interest accounts, the payments banks are being used as transactions accounts. One of their objectives to a much larger extent than full service banks and small finance banks as well. So one of the significant aspects or the context in which payments banks have been functioning is how its functional equivalent of prepaid instruments have been functioning, have been regulated also, right? So like as Madhu mentioned, these wallets are functionally equivalent to payments banks accounts, in which because their deposit limits and transaction limits are pretty much the same. And but payments banks can additionally provide interest on their deposits, unlike the wallets, and they can also provide full CECO services, cash and cash out services, to a significant portion of the economy, which is still very cash dependent, right? And one of the recommendations in the MODE committee was that at the point of licensing of payments banks, the recommendation was to convert the existing PPIs into payments banks or agent operations. But however, this recommendation has not materialized. With respect to how PPIs have been used, we saw that especially after demonetization, there's been a big rise in the use of PPIs. So if you see the volumes so this is where demonetization was, and you see that volumes have increased considerably, and even the growth rate on an average has been increasing. And we see that in terms of the volumes of transactions enabled by prepaid instruments, they service almost 3 times as much as those serviced by payments banks, right? At least in that year. But the question still remains as to what can be the level of adoption of prepaid instruments in rural areas, especially because you require a smartphone because it's a wallet, it's a digital service. So another aspect of PPIs is how, like I've mentioned, their regulatory landscape has changed. So earlier, the maximum limit to which the balances can be kept was only up to 50,000 rupees. But now, with time, the regulations have changed to increase it to a higher limit. A full KYC version of the wallet has a same balance amount as that of a payments bank, right? And other changes that happened were that UPI-related flexibilities were introduced. For example, interoperability, like I mentioned during the timeline, was introduced. So now you can do transactions from wallet to wallet to bank account using UPI, which you couldn't do earlier. And also, again, a limited cash out solution at merchant locations was enabled. So up to 1,000 or 2,000 rupees based on your location was enabled again. So these two details bring increase the competition for payments banks. Right. But however, payments banks still hold a significant advantage that they can provide full CECO services using their large retail networks to customers. So now coming to the challenges that payments banks have faced. First is there was significant violations that were caught by the regulator with respect to institutional conduct. For example, Airtel, both Airtel and Paytm saw bans that they were banned from opening new account because there were concerns about their agents opening payment banks accounts without informed consent. And Paytm again was banned from creating new accounts because of some issues on non-conformity to KYC norms. And Fino too faced some penalty and some fines for violating operational guidelines because they were supposed to keep the balances limited to 100,000 rupees. And several times these banks kind of had apparently there was a violation where the balances went above the regulatory limit and they were brought under fines or violation And so many of these kind of events were in news. But some things to note was, especially with regards to agents, a violation of institutional conduct, it must be noted that these are not exactly peculiar to payments banks, right? Any agent who's working for a bank would be subject to the same problems. But because payments banks are largely agent banking in nature, so they were brought under a spotlight, right? And again, another thing about agents is that there was also a lack of regulatory clarity, in that it wasn't clear whether agents who were undertaking KYC could do it entirely, or whether it needed some intervention in the form of manual a verification by a bank employee. So this kind of problems exist for full service banks as well. But because, like I mentioned, payments banks is mostly agent-based banking, all of these prove to be challenges for the payments banks in India. So another form of challenges were regarding profitability. As we saw earlier, even before operations, there were significant concerns posed by the entities and external participants who were concerned about how this model can profit, especially given the change in the competition space, not just from PPIs but from other payments banks as well. So this is also the reason for which two of the entities surrendered their licenses before even beginning operations. Right. But another thing to note is payments banks, because they've just recently started operations, right? The oldest one is just 4 years old. They still see a high operational expenditure. So the ratio, if you see, this is as of March 2020, if you look at the ratio of operational expenses to total income, the payments banks, the ratio is a whopping 125% compared to just 23% for full service banks. But despite these, there were still profitability claims by two of the payments banks. Fino Payment Banks claimed operational profit after around approximately 3 years of full years of operations, and Paytm Payments Banks claimed profit after 2 years of operations, and it now has declared 2 consecutive years of profit. But still, there are concerns about profitability, and it's suggested that for long-term viability, they need to pursue adjacent revenue sources, like, for example, third-party providing third-party services or products, and also viability can be ensured by the payments banks adopting a platform business model, and the platform business model itself needs scale to succeed. So one way to ensure success is to hold on to until scale is achieved. So that was that for with respect to challenges. Just summarizing what we've seen in the segment. At least in India, we've seen that payments banks have had to face rapidly evolving and uncertain regulatory landscape. And but what they did was establish a huge network of touch points of mostly the non-branch type, and they've also been able to facilitate high volumes of digital transactions, almost as much as full service banks. But with the question of financial inclusion, we cannot answer because we don't know whether there've been whether these touch points or whether these transactions have been inclusive in nature, whether they've enabled banking in how to service areas or how to service customer segments. Right. We've also seen that payments banks accounts in India have been used largely for payments and transactions and not savings as much. Again, the question remains whether these were enabled for underserved populations or unserved population. So one of the ways in which payments banks can better serve their objectives is to be allowed to act as agents to not just banks, but also non-banking financial institutes. And it would also be enable payments banks better if they would able to offer term deposits instead of just demand deposits to their customers. And for the Nigerian model, I think the considerations that they can keep in mind is to see how their payment services banks can overcome exclusions due to institutional constraints, whether through a greater reach or affordability or targeted offerings than provided by full service banks. And another thing that they can do is to see what is the nature of gap that can be filled by payment services banks. It can be either through enabling digital transactions or providing access to other banking or third-party products, or mobilizing small savings or serving businesses. So that's it for my presentation. Thank you all. We'll take questions now.
Thank you very much, Amuya. So I'll call on Deepti very quickly to, give us a comment on various definitions as well as the highlights of this research before Mr. Fatoku wraps up with his presentation. Thank you.
Sure. Yeah, so I think maybe just to quickly, I can see that there are many comments, and we are trying to answer them as we speak. But it looks like there are, and we don't know enough about the Nigerian model. So apologies if my answer doesn't kind of help adequately. But it looks like there are. I think there are a lot of similarities as well as significant differences in the operating environment as well as the extent of serviceable populations out there who require these services and the manner in which they can be reached. So perhaps that is something that we should consider significantly in deciding what kinds of learnings we can take from the Indian model to apply to the Nigerian context. However, I think the big questions that we've tried to answer, and some of the questions also seem to point to is this distinction between what is the role of the agent, which is what we call the business correspondent model in India, and Nigeria seems to have a good network of such agents versus the payment bank model and the touch points that they have enabled. Why did we even imagine the payment bank model in addition to agents? And I just wanted to kind of, so that's one distinction. And the other distinction is what about the full service bank and what are the kind of challenges that the payment bank model try to overcome, which the full service banks couldn't overcome. So hopefully we've tried to answer that throughout. And the third distinction is between the PPI or the e-wallet provider and the payments bank, where the worry was really around contingent risk, not knowing, so opacity, because this was very much a nested model. The wallet provider has one bank account with a sponsor bank. It's an escrow account. And then the sponsor bank does transactions for the various kind of e-wallet holders of that e-wallet provider. And so there was no deposit insurance. And in fact, we had one case where when one of the banks in the country was moving towards a situation where it was actually failing, the PPI wallet provider that was relying on that bank saw shutdown of transactions, and then the people who held wallets in that PPI couldn't access their accounts, right? Even if it was temporary. But these are the issues that these are the kind of the real issues when we imagine a wallet and why the payment bank was kind of conceptualized to solve for issues with the BC model, issues with the full service bank model, and issues with the PPI model. So, it's still very early years. Like Amulya had shown, we have only public claims that Paytm and Fino Payments Bank have made about operational profitability and profitability. But this is a difficult business in the sense that, first of all, you need to have extensive retail physical networks. You don't necessarily need a captive audience, but the competitive landscape has significantly altered the manner in which people interact with banks. I personally feel that it's good that all of these accounts are actually a bank account rather than something with a lower KYC requirement or something where with the whole amount of limited transactions. The payments bank model actually enables all of this while ensuring that kind of stability as well as safety of each account is taken care of adequately to the extent that deposit insurance is there. And in any case, transactions are only allowed up to a limit of 1 lakh rupees. There are certain I would say limitations of the payments bank model, which both Madhu and Amulya would have covered as they were speaking. But I suppose I'll stop here and would love to know what all of this means for the Nigerian context, and happy to take more questions and respond on chat. Thank you.
Thank you very much, Deepti. Before we have the final closeout Q&A, I'll call on Mr. Fatoku to make his presentation. Thank you so much.
Yeah, thank you, Dr. Nkem. The presentation is actually focusing on Nigeria, as we have all been told. We have a brief outline of about 7 points.
So do you want to put it on slideshow mode so that the screen is bigger?
Yes, and it will cover everything. Yeah, I think it's good like this, okay? So we have 7 points: the takeoff, the peer review with India. We will also mention what was done in Kenya, though not a payment service bank, but people often make reference to Kenya when we talk of financial inclusion. We'll see what Nigeria has done, what we are doing, and what may be done. We have a brief progress report, very brief, because as we all know, the final licenses were issued in August, just about 5 months ago. And of course, I am no more a regulator. So like my colleagues from India, I don't have access to the reports of the payment service banks. But we are going to have a progress report, then conclusion, and of course, the question and answer session. Okay, so in the introduction, we know that Nigeria is highly populated, though our population is trailing that of India behind, because we know that India is about 2 billion, but Nigeria, for its size, is also largely populated. It's the most populated country in Africa, with over 200 million people, and a demography of a youthful population. As of 2019, it was reported that about almost half of the percentage are youths. But to compound this problem is the lack of access to finance. Also, the ability to raise capital so that they can be lifted out of poverty has been a big challenge. So, in 2016, it was estimated that about 40.1 million Nigerians, which is about 41.6% of the adult population, were financially excluded. So as we can see in the charts, that's about 2 in every 5 of the adult population. That study also shows that most of these people that were excluded were living in the northwest and northeastern part of the country, and that many of them were women, they were rural-based, and they range between the ages of 18 to 35. An interesting thing here is that prior to the research in 2016, Northeast used to lead in the exclusion, but in 2016, Northwest took over. If you want to know the source of this information, I will recommend that you visit the website of EFINA, which we are going to take some of their reports in the course of this presentation, but you have a detailed report from their site. So apart from the disconnection from finance, a social dislocation also occurs among these financially excluded, because what leads to their exclusion in the first place mostly is because they lack access to job, or the type of work they do not require them to have financial services, to have access to financial services before they are remunerated. So in order to look at this issue frontally and combat it, the Central Bank of Nigeria made a declaration in 2011 with other countries of the world, a declaration on financial inclusion. So a year after that, the strategy was launched, the National Financial Inclusion Strategy. That was in 2012. And it was revised in October 2018. And what was the objective of that strategy? As we all know, as participants in this webinar, we know that the objective of that strategy is to promote a financial system where at least 80% of the adult population will be financially included by 2020. So we take a brief look at some aspects of the EFINA report. In 2010, the adult financial exclusion rate was 46.3, and the target was 20% in 2020, just as we have said earlier. And then you have the product categories and the channel categories for those channels. The latest statistics that I have, I'm sure another research must have been done in 2020, but I couldn't lay my hands on that. I doubt if it has been released because it's a 2-yearly thing. It was done 2008, 10, 12, 14, 2016, and 2018. So in 2018, the report shows that about 36.8% were financially excluded. And that's talking about 36.6 million. But we will also notice, interestingly, that it is not a lost battle. If you take a critical look at that, that chart that I have projected, you will see that in 2008, the percentage was 52.5%, very high, more than half of the adult population. But in 2010, it came down to 46.3. You remember that the Maya Declaration was in 2011, and the financial inclusion strategy was launched in 2012. No doubt, the implementation of that strategy definitely had an effect on the rate of financial exclusion. Because if you look at the figure, the research that was conducted in 2012 showed a decline from 46.3 to 39.7. It was a marginal decline in 2014. You will also notice that in 2016, the figure rose again to 41.6%. So many reasons had been adduced for this. Part of the reasons adduced was the state of insecurity in some parts of the country, which were very, very serious around that time. Another reason that had been given was the suspension of the cashless project, which will have been extended nationwide. You know, the cashless project started in 2012 and in 6 locations, and should have been extended. But that extension, though it was still running in those states where it was implemented, though there were some variations, but that extension was somehow stalled. So that is one of the reasons that some people gave for the increase. But you see that the cashless came back, and because of that, you can see that the figure has gone down. I want to be very, very optimistic that when the result of the 2020 survey is released, we will have a better picture. But don't forget that the timeline has also been extended from 2020. So we speak further on this. So where are we in geopolitical zones? We have 6 geopolitical zones in Nigeria. And as I said earlier, the Northwest is the zone that is that has the highest financially excluded, as at the 2018 report, as you can see it projected, closely followed by the Northeast. But of good note is the fact that the Southwest has actually surpassed the target. This is not surprising because we know that most of the financial services providers in Nigeria are in these parts of the country, and majorly, major economic activities are also in this part of the country. No wonder that the central bank, in its wisdom, issued a guideline directing or encouraging financial services providers to go to the hinterlands, so to say. And we'll see this as we make presentation on payment service banks. Just as we have it in India, and just as it was presented, we will also see that the same principle apply here. So that what has been achieved in the Southwest, which is showing 19% as of 2018, could also be replicated in other parts of the country, especially the Northwest and the Northeast, if certain things could be put right. The strategy for the Payment Service Bank is to, as we said, or as we all know, is to accelerate financial inclusion. And that is looking less at traditional financial institutions, such as the deposit money banks, and to focus on new entity that will combat the challenges to reaching the rural communities, as well as complement the services that were provided by these other entities. So this led to the release of the guideline providing for the licensing and operation of payment service banks in Nigeria in 2018. I must say that we owe a lot of thanks or appreciation to India because before those guidelines were released, a study tour was conducted with the RBI and various other entities to see how that project was moving in India. And many of the guidelines, as you see, and as been presented, actually came from as a result of that study tour. But there could still be some tweaking of those guidelines. And as we see, it was not a copy and paste. You will see that when comparison was made between the payment service banks in India, the guideline, and the payment service banks in Nigeria, it was not a cut and paste. Areas that are peculiar to Nigeria were moderated or modified so that it will suit the purpose of our client. So in August 2020, 3 entities, Nine Payment Service Bank, Money Master Payment Service Bank, which are owned by the telcos, and Hope Payment Service Bank, which is owned by a fintech, which were hitherto granted approval in principle, were given final license. So in August 2020, they commenced operation as payment service banks. We know that according to the guideline, the focus of the payment service banks is to facilitate high volume, low value transactions in remittance services, micro savings, and withdrawal services in a secured technology-driven environment. For what purpose? To deepen financial inclusion. And of course, to help in attaining the policy objective of financial inclusion of our 20% exclusion rate by 2020. That is at least 20% exclusion. So if the exclusion rate is, at most. So if the exclusion rate is lower than that, as it is currently in the Southwest, the better it is for the attainment of the strategy. Well, 5 months ago, the 3 payment service banks actually were granted final licenses, and shortly after, the 3 of them opened their shops. One of the questions that was sent prior to, this public webinar, one participant was asking whether apart from one, he specifically mentioned one payment service bank, whether apart from that payment service bank, the other 2 had actually started operation. And the answer is yes, they have, but at different stages of commencement of operation. So, but part of the challenge that the payment service banks will face is the restriction on credit, offering of credit facilities. That is also what happens in India. But at the end, or towards the end of my presentation, I have some thoughts that I think we can share on that. Then another will be maintaining the current KYC requirements. In the Nigerian banking system, we have a tiered KYC, tier 1, tier 2, and tier 3. That, of course, may also pose a challenge for them. But I don't see it as a showstopper. There may be challenges, but they are not a showstopper. Another challenge may be the low prices in the payment space in Nigeria. As most of us, or all of us are aware, prices in Nigeria for banking transactions are regulated. Though part of that regulation, we still have some that can be negotiated between the payment service provider and the user of the payment service. We have some that can be negotiated, but most of them are regulated. And that is, it's either a specific amount is prescribed for the provision of that service, or a gap or a bound is given. This could be a challenge for the payment service banks in Nigeria. But like I said, they are challenges. They are not showstoppers. Because it is expected that they will leverage their robust capital, 5 billion naira, they will leverage the strong brand presence of these outlets that have been licensed as payment service banks, and that they will leverage technology and also embark on good marketing and communication strategies that will help them to overcome these identified challenges, that is low prices, and which I believe may still continue to go down. Why? Because part of the reasons for financial inclusion by studies that have been conducted in Nigeria is that the prices paid for services provided is too high. Yes. So for us to bring in, for central bank to bring in more people to enjoy financial services, the price must be affordable, I know for the service providers, they will always ask, but that is not sustainable. But evidence is also given that in spite of the reduction in prices, profits are still being made. Yes, I know this is a discussion that may come up as a part of the question and answer. But of course, prices must be affordable so that as many people as wish or are qualified can take advantage of what is provided by financial institutions or payment service providers, including the payment service banks. So, like I said, we are going to talk briefly about Kenya. And why we want to talk about Kenya is because of what many people have said about the M-Pesa model in Kenya. People have alluded to the fact that Kenya has a success story with the M-Pesa model because they allowed a telco-led model, that is, telcos cooperate as what is called in India the PPIs, which we call in Nigeria the mobile money operators. Well, so many discussions have been made in that area. Well, but we know that the guideline for the licensing of payment service banks specifically mentioned the telcos that they can participate to actually open a payment service bank. And that is why we see that out of the 3 that were licensed initially, 2 of them are actually telcos. But why were telcos excluded then? I think it would be also good to speak briefly about this before we move to the next point. There were various reasons that were given by the regulator, but principally, one of the reasons is the issue of oversight, regulatory oversight, which could lead to regulatory arbitrage. Because if I am regulated by you and also regulated by another regulator, there is the need for very strong synergy between those 2 regulators. But it is not always that that synergy works. So there could be regulatory arbitrage, which will be detrimental to the system. To put it in a milder way or in an illustrative way, it could be like giving a woman as a wife to 2 men as husbands. Who owns what? So because of the regulatory arbitrage that may occur, that was why telcos were initially prevented from playing in the payment service industry. But that has been captured or conquered by allowing them to play in the in the payment service banks, because they are required to set up a different entity from the parent body. And that is why you can see that the 2 telcos that are licensed, except you have background information about them, you may probably not know that they are actually owned by telcos, because they are licensed as a subsidiary or as a separate company, a separate legal entity that the central bank, which is the regulator of the financial services, will have oversight on. Now, I'm not going to talk about this peer review of India because we've had it from the horse's mouth. Deepti, I'm not calling you a horse, so it's just what we say in Nigeria here. When you get an information directly from the source, we say that we have had it from the horse's mouth. So we are not going to discuss this. Let's move on. So what is Nigeria doing and what needs to be done, or what has been done? We know that in the payments service industry, a unique problem is the problem of identification. If that problem is not addressed, then there will be trouble. Or as we call it in Nigeria, there will be wahala. Aha. India took good steps to address that problem by the Aadhaar project, which is a unique identification for all Indians. And the last I checked, it's only less than 2% of the population of about 2 billion that have not been captured. We know that Nigeria also made a move in that regard with the NIN then, but it was a, let me say, a knee-jerk approach. So that was why the Bankers Committee and the CBN sponsored the BVN drive. And that led to the registration of over 40 million banking customers. And with that, the issue of identity in the Nigerian banking system was really addressed. So that paved the way, or paved the way for the payment service banks, so that at least the issue of identity of their customers will not be a problem for them. Also, another thing that central bank has done, which will be of advantage to the payment service banks, is that before now, banks are allowed to issue wallets even without asking the central bank for approval. Initially, when we started licensing the mobile money operators, oh, sorry, did I say we? That's a slip of tongue. When they started licensing the mobile money operators, because I'm no more there, when they started licensing the mobile money operators, banks that also want to operate a mobile money operation had to apply for a license, but that had been removed. All that were things that were done by the central bank to ensure greater participation of the payment service providers in areas or strategies that will enable financial inclusion. So as we said, the Nigerian Payment System Vision was extended by 5 years to 2025. And part of the recommendations or things that will be done during this extended period is an increased drive in agent banking. We are all aware of SANEF, Share Agent Network Facility. Central Bank and the Bankers Committee are driving this process by even making, empowering the super agents to be able to provide excellent services, especially in areas that are not currently covered. We heard of the UPI in India. Central Bank of Nigeria is also looking at something like that, a centralized USSD that could be accessed by all financial service providers for their services. And of course, we know the central switch will be the hub for this. And part of what has been done also, as we know, that one of the things that discourages financial inclusion, one of the things that discourage financial inclusion is the issue of consumer protection and trust. When those that are unbanked hear unpalatable stories, so to say, about what happens to those who are banked, it leads them not to want to patronize any bank. So because of this, the Central Bank of Nigeria put in place a very robust consumer protection measure. In fact, establishing a whole department in the Central Bank of Nigeria to look at consumer protection issues so that the confidence of the bank public will be increased. And invariably, this will also lead to an increase or trust in the system by those not banked so that they also will be willing to come in. We've talked about NIPS, and the purpose is serving, ensuring interoperability and interconnectedness so that all players in the industry will be connected. And then the issue of transfer, receipts, and settlement will not be a problem. Of course, recently, the bank released the regulatory framework for Sandbox and also the regulatory framework for the adoption of QR codes, which no doubt will ensure interoperability of the schemes. Two other things that have been done will also be mentioned. I mean, they were done just, I think, this week or last week. So what is the progress report? From information available to me, this is aggregate, so to say. The payment service banks, in a space of 5 months, have onboarded 500,000 customers to date. For those of you who have read the guideline on the payment service banks, they are required not only to onboard customers, but in rendering their returns to state whether those customers were already financially included or not. Because as we know, the focus is getting those that are not financially included. So that it will not just be a situation of someone using a bank account, already having a bank account, maybe already even he has a mobile money wallet, and then enrolling as a customer of a payment service bank. That should not count. But of course, it's only those who analyze the returns, those who receive and analyze the returns, that will be able to speak further on this. And I'm sure that down the line, central bank has always had a custom of transparency. Down the line, this information will be publicly available to us so that we will be able to assess. Hello?
Sorry, Mr. Fatoku, you need to wrap up in the next 4 minutes so that we can take, you are actually overshooting your time, sir. Thank you, sir.
Have I spent 20 minutes?
Yes, you have.
Oh my God, okay. All right, so let me go to the enablers. Creation of a central, I think we have talked about this. Okay, NEF, which is the anti-fraud forum, then the BVN, and recently, the revision of the operation guidelines for payment service banks in 2020, and the framework for open banking. Yes, this is, somebody asked a question about this, and that's why I decided to include it. The payment service banks are also players in the financial services industry, and I'm sure that the requirement for open banking will be applicable to them. But mind you, that framework that was released also said that the operational guideline will be released, and I'm sure Musa and his team are already working on this. When that operational guidelines are released, I will have specifically how the payment service banks will be included, but they, of course, will be included. The challenges ahead, inability to overcredit and insurance services is a major challenge. I saw somebody ask a question about that. Well, personally, and please, this is my personal opinion. You know, I'm no more a banker. That's why you can't see me wearing tie. It's my personal opinion. And don't say former director. It's personal. This is just fully now. Personally, I think that there may be the need to look at the offering of credit by payment service banks. If organizer that has been enrolled, maybe contributing money or whatever, using it for payment, at a time they want to buy a organizing machine of say 100,000 or 150,000, for him to be directed to a bank, well, I don't know. But on the flip side is the fact that for every naira that a bank gives out as loan, he must set aside part of his capital for it. So allowing the payment service banks to overcredit may also lead to an increase in their capital requirement. So I'm sure the bank will balance this and see whether it is something that could be allowed. Part of the challenge also is the infrastructure challenges, internet penetration and affordability. In India, internet is cheap and it's widely available. In Nigeria, that is not the case. It's not the case. In fact, most banks are using USSD because internet is not available in most areas. And in areas where they are available, they are a bit expensive, although not as expensive as South Africa. So these are some of the challenges that, so I'm concluding now, my moderator. So going forward, we are sure that the CBN will watch the operations of the payment service bank as they grow, and that we hope and think that their scope of operation may also be broadened, and that the payment service banks will also embark in financial literacy and extensive awareness effort, which will be a key that will drive their objectives for the purpose of setting them up, driving low value but high volume transactions. So that is all from me. But my moderator, Doctor, will you allow me, give me 2 minutes to answer some of the questions that were sent in before this, or do we take it as part of the question and answer session so that I won't be giving you a red card?
That's precisely the point, sir. We're trying to reserve the time to answer the questions directed to you.
Okay. All right. Some questions were certain.
Yes.
Some questions were even certain before the presentation. So let me stop my screen sharing so that I can see the questions. Okay. But before I go to the questions that we have on the Q&A, I want to take some of the questions that were sent in at the point of registration. There are many, but I will just take about 4 or 5 of them. The first question is that this is not the first time CBN will introduce an intervention. In what practical ways will the Payment Service Bank's model further the inclusion of a greater advantage of Nigerian population? And we have addressed that their branches, as much as possible, will not be in brick and mortar. It will be electronic. And because of this, we expect that they will be able to serve many people. The second question is on the prospect of PSB services, as well as the limitations vis-a-vis open banking. We have addressed that. The third question is that what role will aggregators, that is agency network managers, play in the Payment Service Bank regime? Is the role they have been playing, because the Payment Service Bank is not radically different from other banks, except that they cannot provide credit, they cannot do foreign exchange. How can phone numbers become valid account numbers for all financial institutions? I want to say that this is already happening. Many banks in Nigeria are already doing this, and I think the payment service banks will not be left behind. What is the competitive position of the Nigerian financial sector based on the presently imposed restrictions on PSB offerings? Like I said, playing in the financial services industry is also a function of capital. The capital availability to payment service banks is not robust enough for them to carry a large risk. If they do, especially credit risk, if they do, it may weigh them down. I think this is one of the reasons why there are restrictions. But with time, when they grow, it's possible that probably they could be allowed to metamorphose into other players if that is allowed, although there is no provision in the guideline for that as at now. Somebody asked a question why some telcos were not licensed. I want to say that that is beyond me. It's beyond my pay grade. It's only the central bank that can answer it. But you know that licensing of payment service providers is not only dependent on the capital you provide. There are so many other considerations that are taken into effect. So with that, I've answered these questions that are here.
Okay, thank you very much. So let's quickly move to the other questions here. So there's a question which I think you can answer in less than half a minute. Can existing banks partner with the PSBs for on-lending to customers?
No, PSBs cannot take credit risk. So they cannot go into what is called a syndicated loan arrangement or give loans on their own. Partnering is syndication. If you are not allowed to do something on your own, of course, you cannot do it in conjunction with others, except when the guideline changes.
Okay. What, in your opinion, as a seasoned consultant, should an existing telco or switching company that has secured a PSB license do to leverage on, either as a quick win, considering the very hot and intense competition in the Nigerian fintech and banking space?
My moderator, as you said, I'm a consultant, and if you want my advice on consulting, it should not be free. Or what do you think? All right, but since Lagos Business School has paid me for this, I want to tell whoever is asking that question that the best thing is to roll out your channels digitally and give it enough publicity. Not only that, the agent banking network that was rolled out in Nigeria is unique. Unique because we have non-exclusivity of agents. If a bank has recruited an agent, any other bank can make use of that agent. So the payment service banks do not have to go out establishing their own agents. All they need to do is, I won't use the word poach, but leverage what is in existence. But they can also develop their agents in areas that are not currently served. That will help them.
Excellent, excellent. There's also another very quick question. What are the KPIs for PSBs that can help in achieving the expected inclusion?
I think we've discussed this. The critical performance indicators will be digitization, marketing, and ensuring that they earn the trust of their customers. Of course, the guide to bank charges, which is one of the reasons why people don't patronize banks, is because of the high cost, as we said. The guide to bank charges gives the maximum amount that you can charge. If the guide to bank charges say you should charge 100 naira. If you decide to charge 50 naira, central bank is not going to penalize you. So that will also be a KPI for them to penetrate the market. If they can charge prices that are attractive to those that are financially excluded. In fact, some services could be rendered for free, just to bring them into the bracket. And of course, you know, once you have captured them as your customer, then whether you like it or not, there must be returns from services provided in the future.
Why is this still a challenge to have BVNs across the 941 microfinance banks in Nigeria?
I'm surprised at that, because I know that as far back as 2017, yes, 2017, there was an arrangement made by the Bankers Committee with NIPS, where selected microfinance banks in some areas were given the opportunity to enroll for BVN. And the devices that were provided for them, they were not the one that bought them. It was the devices that were bought by the Bankers Committee. But so I'm surprised at this question. Maybe this is one of the questions the LBS may escalate to the central bank, because I know that that project was actually working very well. In fact, I remember that some of my staff then were even deployed to work with the microfinance banks in this enrollment for BVN.
Okay, excellent. Now, there is a very interesting question/comment here. I have an alternative view on partnering with telcos to offer credits. They can actually use the telco entity and not their PSB license in this partnership, I think. That's the view of the attendee, sir.
Well, he may be right, but he is wrong, to speak as a Nigerian. Because when you talk of giving credit is not one of the functions of the telcos. Their function is to provide infrastructure. But we do know that they give micro credit, but that micro credit is not outside their network, because it's a credit. If they say borrow me data or borrow me recharge or whatever, it's a form of credit. But that credit cannot be used for any other thing apart from services within their network. If they decide to be giving credit for other services which is not regulated, I don't think they will still be within the scope of their operations.
Okay, thank you very much, sir. There are also some very interesting comments. Okay, now the last one is super agents via SANEF were informed not to integrate and work with PSBs. In this instance, PSBs cannot leverage existing agent networks in the SANEF umbrella. Don't we think this will hinder the takeoff of PSBs?
TT is an informed participant, very, very informed participant, but I must say that I'm not aware of these requirements by central bank. I think it's an issue if Musa wants to address, or maybe Lagos Business School will discuss it with him. I'm not aware, so I cannot comment on it. But I know TT is well informed, so she won't be saying something that she's not aware of. She's also a major player in the payment service industry.
Okay. Okay, thank you very much, sir. Just like you've instructed, Lagos Business School will take it up offline. Distinguished guests, panelists, ladies and gentlemen, thank you so much. It's been a very exciting presentation. Would look forward to welcoming you to our further sessions in this series. And we look forward to continuing and strengthening the engagement. For those of us who are registered, we'll share the publicly available materials from this program. And we thank you all for your time.
Sorry, doctor, sorry, just a minute, please. I saw a question here. Somebody is asking whether disbursing loans on behalf of bank or government is considered syndication. I want to answer that question because I'm sure he's asking because of the limitations on PSBs.
Okay,
It is a loan if the one disbursing, has the credit risk. If you are the primary obligor for that disbursement, though the money belongs to government or belongs to any other person, you are the one disbursing. But if you are the primary obligor in the course of default or in case of default, then it is still a loan and it is a syndication.
Okay. Okay. Thank you very much, sir.
Thank you.
Very useful comments. And then for all the other unanswered questions, we would make best efforts to try to answer them and then send out. Thank you very much, ladies and gentlemen. Have a wonderful day and enjoy the rest of your afternoon, evening, or morning, depending on what part of the world you are. Bye-bye.
Bye-bye. Thank you, Doctor.
Bye. And thank you for the DEFRA team as well for the excellent sharing. Thank you all very much.
Thank you for having us all.
Thank you.
Thank you, DP, Amia, and Madu. I benefited a lot from your presentation.
Me too.
Yeah. Bye.
Bye.